Right. Good afternoon, everyone. Thank you so much for joining our latest and greatest webinar on all things psilocybin and 280E with a specific Oregon focus, though I know that we've got a lot of friends tuning in from Colorado, across the country, and maybe even a couple of folks around the world. For those who I have not yet to meet, my name is Sam Chapman. I'm the executive director at the Healing Advocacy Fund. And the Healing Advocacy Fund is a 501c3 nonprofit that works to implement safe, high quality, and equitable psychedelic therapy here in Oregon and Colorado and other states to come. We're going to give folks another minute or so to join. We had well over 100 folks that signed up for this webinar, which just shows how much interest there is in this subject. This subject, from a public perspective, is hardly talked about from the outsider perspective. But it is absolutely, without a doubt, one of the most popular items for prospective operators, facilitators, and the general curious around Oregon's psilocybin therapy program. And we've got a whole host of folks that I will allow them to introduce themselves in a second. We've got attorneys, multiple attorneys with different backgrounds, and a handful of CPAs as well. One of the things that I've always said about operating, not just in the cannabis space, but now the psychedelic space too, is that your business is politics. And if you're not paying attention to the politics, you're simply not paying attention to your business. Today's webinar will show exactly what I mean by that. It will not be me. I am not a tax expert. I'm not an attorney. I'm not an accountant. But those are all things that you will need if and when you do decide to move into the Oregon psilocybin therapy space. Despite there being very real challenges, not both financially, but legally as well, and some of those that we're going to talk about in terms of tax challenges, there are opportunities to overcome those challenges. And I think that we're going to have a really fruitful discussion today between all of our participants about what some of those challenges are, what some of the opportunities to overcome those challenges we're starting to see out in the field, and how to really start thinking about assessing whether or not you want to move forward, and if so, how to do it, and a small sampling of the types of folks that you might want to hire sooner than later if you are serious about moving into this space. So with that, I know that we're going to continue to have folks joining here, but I'm going to go ahead and kick us off because we've got so much to talk about. And I'm going to go ahead and hand it over to Kaci from the Emerge Law Group. Kaci, if you'd like to go ahead and take it away.
Yeah, hi everyone. Thanks so much for joining us. Thanks, Sam, for the great primer on our conversation today. My name is Kaci Hohmann. I'm a business attorney at Emerge Law Group. I'm going to go around and just let the speakers give a super brief introduction about themselves so that everyone here kind of understands who's who. So Dave, would you want to start us off with your intro?
Sure. Hi, everybody. Dave Kopilak. I'm a business law attorney at Emerge Law Group. Work closely with Kaci, and we've got a number of attorneys who are helping folks in the Oregon psilocybin arena, and it's all very interesting and exciting, and we're hoping to help as many folks as we can with a successful launch. So I guess I'll just turn it over to Matt then, maybe.
Sure. My name is Matt Walding. I'm a transactional tax advisory attorney. Have the opportunity to do quite a bit of work with Dave and Kaci at Emerge, and I'm based in Oakland, California.
And Dean, would you like to go next?
Sure. My name is Dean Guske. I'm a CPA. I have a practice in the Seattle area. I've just kind of recently got involved in the psilocybin space. I've been in the cannabis space for 10 years or so. Several hundred clients in that space. And so I find this will be an interesting discussion for sure.
Yeah, no doubt. Scott, please go ahead.
Good afternoon, everyone. I'm Scott Bargaehr with Lewis Group CPAs. I am a CPA myself, and like Dean, we've been practicing in the cannabis space probably about a decade, since the medicinal days of cannabis. And naturally, that just flows into the psilocybin space. So I'm excited, along with the rest of you and with Dean, to hear from a bunch of professionals and get to put our minds together and hopefully learn something.
Awesome. Thanks, Scott. Okay, so with that, let's go ahead and get started on the presentation. Just give me a second while I share my screen. Okay, can everyone see the slides? All right, so 280E and psilocybin, understanding and mitigating the impacts. You now know who the speakers are, and we can go ahead and advance. I think, Dean, maybe you were gonna do this first slide.
Yeah, and actually part of it is cut off for me, but this is this is the section of the Internal Revenue Code that's been in place since 1982. And you can see it says this was the result of a long ago tax court case, and Congress that the IRS actually lost in a trafficking situation, and the IRS wasn't really all that thrilled about it. And so they didn't think that as a public policy matter, people who were trafficking in controlled substances, marijuana, cocaine, heroin, whatever it happened to be, should get tax deductions for it. So you just read it. This is the whole statute right here. What it doesn't say is it doesn't say that you don't get cost of goods sold, which in fact you do. This is a constitutional issue that probably not, we don't need to talk about today, but the only deduction that you do get in the Internal Revenue Code is cost of goods sold, nothing else.
Right, and so the effect of 280E, as Dean was just saying, is that it's a business who is subject to these rules because they're deemed to be trafficking in a controlled substance receives no tax deduction. So there are no business expenses that are deductible against gross income. As Dean just indicated, they can reduce their gross income. So it's an adjustment to gross income for cost of goods sold, or COGS. So gross income minus COGS equals taxable income. At the end of the day, if you are able to recognize those COGS to adjust your gross income, they have the same economic impact as a deduction for a business expense, but they are technically a different calculation and methodology for reaching that same result. So COGS are direct costs of acquiring or manufacturing merchandise that a business sells. So it relates to inventory primarily. If you're producing a product or you are selling a product at retail, what are your costs to produce the product? What are your costs to acquire the product that you're going to resell? Those are your COGS, more or less. It boils down to that. There are some indirect costs that might be classified as COGS under the regulations, but effectively it is, how do you incur expenses to create merchandise or to sell merchandise? If you don't have merchandise, if you don't have inventory, if you just are a service provider, for example, no COGS, no goods equals no COGS.
So essentially the game as a business that's trafficking in a Schedule 1 or Schedule 2 substance is, when you're subject to 280E, what can you put into COGS? So your general selling, general and administrative expenses are no longer deductions. They're disallowed under Section 280E. So you're left with the question of, okay, well, what can I put into COGS? So some of the primary things you can obviously put in there are your direct material expenses. So whatever it costs to actually make the product becomes your cost of goods sold. Direct material costs, you can also put direct labor costs in that same cost of goods sold bucket. And then there's also some indirect production costs. So things like some management salaries, rent of a space that's specifically used for manufacturing, utilities on the same space. I love that we have allocations in red with an exclamation point there. A lot of our conversations with the IRS when we are discussing this, a tax return with the IRS when they're asking questions, is how did you determine your allocations? And so those indirect costs, as a business, you want to put as much as you can into that cost of goods sold, but you have to have a reasonable method. Under Section 471 of the code, when you're coming up with your cost of goods sold, you have to use a consistent and reasonable method. And so when you're coming up with your cost of goods sold, you want to make sure you have a documented methodology for how you determine which salaries are indirectly allocable to your cost of goods sold. And there's tons of methods to do that, but you want to make sure you document it. And then pretty much everything else is not cost of goods sold. Your general administrative overhead costs, all of your, your computing, your desk, everything, paying your CPA, your accountant, all the people on this call here. None of that is deductible. It's still an ordinary and necessary expense of your business, but the deduction for it is entirely disallowed. And you notice down on the bottom under not COGS, we also have some salaries, rent, and utilities, because you've got to split those two. The best example I can think of for how you would allocate cost of goods sold versus not cost of goods sold is, let's say you have a building that you're leasing to manufacture, essentially process the psilocybin and get it to a usable state. The portion of that building where you're doing the processing could be allocated as an indirect cost of goods sold, but the portion of that building where you're just sitting there doing, your accounting, doing your sales on the front end, that's not an indirect cost of goods sold.
Sorry about that. I needed to unmute myself. So one of the things I also wanted to talk about is, don't let 280E be the focus of your business, right? So many times I think a lot of us have experienced that, that have been in the cannabis space for a long time. I think early on, people kind of focused a lot of energy into 280E, and look, taxes aren't fair. They're not fair for anybody. I think you need to have a general understanding of this, but it shouldn't be necessarily the focus of your business. Yes, are you going to pay probably more tax than you would otherwise? Absolutely. There's really going to be kind of no way around that. I mean, and I'm sorry, guys, I kind of have the slides are sort of hidden behind some of the.
Is anyone else having that problem? Okay, I think Dean, maybe it's the way you have your screen structured, but it's okay if you can't see all the slides. Maybe Matt could just pick up for you and take over that slide.
Yeah, I mean, Dean's point he was just making is great, though.
I got it.
Oh, you got it now. Okay, great.
It's fine. Go ahead. That's fine, man.
Yeah, I mean, his point is a good one. If you're heading into this, to think about taxes as the primary reason for structuring your business is not good. It's not a good business approach, right? Taxes need to be part of your planning, but if your sole focus is on 280E, you're focusing on the wrong things. I think I would agree with Dean, who said that earlier. So problems generally under 280E. Actual costs and expenses will always exceed COGS. It's not possible to have 100% of your of the outflow of cash be categorized as COGS in any kind of business, even in producing and manufacturing. And trafficking businesses will never be able to deduct their ordinary and necessary business expenses. That's the function of 280E. So as a result, taxable income is always going to be greater than actual profits, which is it's perverse from a business perspective. If you compare other businesses who you're competing with who are not trafficking controlled substances, they just from a business perspective, the fact that a trafficking business will have taxable income in excess of profits puts these businesses at a disadvantage. And trafficking businesses, as a result, will pay taxes on phantom profits, which is that concept of taxable income being greater than actual profits.
So you have two different types of businesses you can run as far as a cost of goods sold perspective within 280E. When you're manufacturing, everything we were just talking about what falls into your cost of goods sold can apply. Your direct costs, your direct labor, and then your indirect costs. So if you think about that, that's the bulk of your manufacturing costs. And so your situation's not fantastic. Like Matt and Dean were just saying, you're going to pay tax at a higher rate than a non-280E business. But it's also not that bad. You've got a lot of expenses, a lot of room to allocate expenses into cost of goods sold. And so you should be able to squeeze a bunch of it in there. Kids, if you want to go to the next slide, I'll just keep rolling here. To contrast that, a service center is not doing any manufacturing. And there's potentially a really significant problem with service centers because they're not doing any manufacturing. They fall under a different section of the code as to how they get to calculate their cost of goods sold. And all that is allowable in a service center's cost of goods sold is the cost of the product and the freight in. It's a much more limited list. That's it, those two things. So the cost of purchasing the product and the freight in is what is allowed under Section 471 when you're calculating your cost of goods sold as a service center. So when you're doing your planning, like Dean and Matt were just talking about, to look ahead for, okay, what's my tax impact going to be? It's a very different impact for a manufacturer of psilocybin versus a service center operator.
Yeah, I kind of want to jump in on this as well. And this is similar to 280E, obviously it applies to cannabis businesses. And I remember when I first kind of got involved with cannabis companies about 10 years ago, we kind of understood that 280E was going to impact retailers much more than they would, impact the producers and processors. And so, the producers here, sure, the vast majority of their expenditures are going to be deductible, but and for the service centers, very little will be deductible. So it'll be interesting to see kind of where the profits end up falling. So the impact, to the service center, the service center is going to be probably having much larger revenues, I would suspect, than the producers at this point in time. They'll kind of control the game a little bit. And so you have to kind of keep all those things in perspective. Like in Washington State anyway, and several other states, the retailers are impacted the most from a cannabis standpoint by 280E, but that's where all the profit is. So it's kind of, again, going back to my comment about don't get like overly worked up about 280E, kind of keep all these things in perspective. And if you're meeting with us attorneys and CPAs, we're also going to have some suggestions around, how you would structure your business kind of once we understand the facts of what you want to do. So.
Dean, do you want to finish up this slide, or are we ready to move on?
I think we can keep going. We can move to the next one. So this one is kind of interesting, and I think I'm going to ask maybe Scott to also jump in on this, and possibly Matt, because we were talking about this offline, prior to kind of jumping in here, and there's some differences of opinion. Like what we had said is, ask 3 accountants a question and you'll get 5 answers sometimes. So facilitators, in my mind, if they're independent contractors and, they may not have a 280E problem at all, because trafficking for federal income tax purposes is decided in some tax law as regularly buying and selling a Schedule 1 or Schedule 2 substance. And so the facilitator is, and Dave, you can correct me if I'm wrong, but they're not even allowed to touch the product. Is that correct?
That's correct.
Okay. And so they wouldn't be necessarily be trafficking in my mind, but I think Scott had some comments earlier that, he maybe a different take on it, or that you may want to kind of bring up.
Yeah, absolutely, Dean. And I agree with everything you just said there. And I really agree with your point about ask 3 different CPAs, you're going to get 3 different answers with respect to 280E, because there's so little tax court precedent. In my experience, the IRS has not been letting cases go all the way to court unless they know they're going to get a favorable result. And then they can't write an audit manual because it's a federal crime to do the business. And so they can't write an audit manual for the business. So there's a lot of gray area in this space. And what we've seen is, because there's such a large gray space, there's not a dedicated tax case or tax code we can push back with the IRS on. And so it often falls to the particular agent or group of agents that you end up working with. And one of the arguments we've seen with those agents is they've taken the position that this facilitator wouldn't essentially have a business if there wasn't psilocybin involved. And so, yes, they're not actually touching the product, but they're working with patients that are about to use or have used or are currently using the product, and that's part of their service. And so I could easily see the IRS taking that position. We can easily give them some pushback on that with the argument Dean just made about, well, they're not actually trafficking by the technical definition of trafficking. And the best example I think that comes to mind from the cannabis space is a building owner that they're not producing, they're not manufacturing, they're not retailing, they're just leasing a building to a business. Now that business happens to be a retail cannabis space. Is that landlord now trafficking? And I've had IRS agents try to take the position that they are. So far, we've been pretty successful in pushing back and saying, no, that landlord's not trafficking. So it's really a question that still remains to be seen, whether the IRS will allow facilitators to consider themselves not trafficking, but it's up in the air. It's a gray space right now.
I'll just jump in and say I agree with what's been said so far. I think maybe we have less disagreement than we thought we did, but it's a gray area. I think there's the question of the activity itself that a facilitator is doing. Is that activity trafficking? And then, as Scott alluded to, you have to look at the bigger picture. How does that facilitator's business fit into the entire business model? You look at all of the facts. Is there common ownership? Are they truly an independent contractor? Do they have customers who are not the same customers as the service center? So you have to kind of look at the whole picture. And definitely, if you're doing a risk analysis, you need to talk to your attorney and CPA about all of the facts, not just the ones that are favorable to you before you take a position.
Yeah, I agree. And I think, one of the things you might want to look at in these scenarios is like, who is the service center? Who is the facilitator? Where's the flow of payments coming from the customer possibly could impact that. So lots to consider.
Okay, and just to wrap up this slide, because I'm not sure that we actually touched on the 2 bullet points here. There's not really a 280E problem for facilitators who are employees of a service center because an employee doesn't have their own trade or business. But for facilitators who do have their own businesses and are independent contractors of a service center, there's a potential problem because facilitators will have no COGS because they won't be acquiring or manufacturing any goods. And Dean, I saw you unmuted yourself. Did you want to add anything to that?
No, I don't.
Okay.
I have I'm technically not all that great, so.
I think we've kind of touched on this just a moment ago, but to run through this slide quickly. So trafficking, it's defined mostly in case law. The IRS has certain unpublished views on what trafficking is. We see some of their perspective in the positions they've taken in the published court cases. As Scott indicated, in an audit, you might come up with some even different positions we didn't know they were taking, but effectively trafficking includes bartering or buying and selling a Schedule 1 or Schedule 2 drug, transporting that product. Manufacturers are definitely trafficking. Service center operators, they are definitely trafficking, at least with respect to the retail activity. And then facilitators, we have 3 question marks because it's a 3 question mark gray area.
All right, so I'm just going to briefly touch on some OHA rules that could be helpful for service center operators. Certain OHA rules provide a little bit of flexibility for CPAs, tax attorneys, business attorneys in the space who are looking to kind of get creative to help mitigate 280E's impact. So for service centers, some helpful rules are related to the licensed premises itself. The licensed premises can be less than the entire leased premises space. And within the licensed premises, you have the concept of the limited access area, which is where the inventory is stored or produced. And then you can have 1 or more client administration areas. And there is a prohibition on service center operators subleasing any part of the licensed premises, but they can authorize the temporary use of the licensed premises for activities that are unrelated to the exercise of their license privileges. Additionally, 2 or more entities can be co-licensees on a license, which can be helpful for separate lines of business purposes. And then service centers are allowed to engage facilitators on an independent contractor basis, as opposed to just hiring them as employees. And then likewise, there's some OHA rules that are helpful for facilitators themselves. The fact that facilitators have the ability to either be an employee or an independent contractor of a service center is helpful. They're also prohibited from practicing any other licensed profession while they're providing facilitation services. They also can't transfer, sell, or handle the psilocybin product itself. The service center is the one that has to provide the product to the client. And then there's 3 separate sessions under the OHA rules for facilitators and clients. There's the preparation session, which is the pre-psilocybin consumption session. It does not have to take place at a service center. There's the administration session, which does have to take place at the service center in a client administration area. And then an integration session, which is optional. It does not have to take place at the service center, and it occurs post psilocybin consumption. So I'm going to kick it over to Dave now.
Okay. Hey, everybody. So this is a sort of a obvious slide here. If you can take the position that you're not trafficking, great. You don't have to think about 280E. If you are trafficking, it would make sense to try to reduce your expenses that are not COGS. So like everybody's saying, you shouldn't just fixate on 280E, but it makes sense to sort of plan. And I think that's a lot of what I've been doing with some clients in this space so far is figuring out kind of how to structure something. And for me as a business attorney, I almost require my clients to engage a knowledgeable CPA. I think I've said it to many clients, like it's sort of a 3-way conversation with myself or Kaci, a business lawyer, the client, and a CPA. We all should sort of, put our heads together, figure out what's going on, and come up with a game plan, and then implement that with entities, organizations, and business plans. So one of the really, really amazing things I think about 109 is the variety of things that can happen at a service center. Like Dean, I've been in the cannabis industry for 10 years, and anyone who's been in a cannabis retail store can usually see it's nothing but a cannabis retail store. There's not much else going on, and I always thought in the very early days of cannabis that businesses might have a second line of business. There might be other stuff going on. I remember talking to clients who they wanted to do a coffee shop with a dispensary or a place to hang out. I never saw that, at least in Oregon. It's been just these, basically these corner stores, and that's your dispensary. But in talking to clients and listening to the various rules advisory committee and just hanging around the scene here for the last couple of years since Measure 109 passed, I have certainly seen a variety of different business models for service centers, ranging from large destination retreats to, on the one hand, to just small little sort of therapist counseling type rooms, to microdose ideas. Like there's just a whole bunch of great things that can happen. And so when I'm talking to a client about initial entity organizational structures, contemplating 280E, I usually start off with asking the client, like, what is your, at least service center clients, what is your service? What do you want to do? What's going to be going on at your service center? What does your place look like? And the variety of answers is very interesting. So I think a second trade or business is way more, I think they're going to happen here with service centers. I've talked to folks who just contemplate having, obviously, psilocybin administration sessions at service center, but also other things that are not related to psilocybin, just regular counseling sessions, regularly therapy sessions, having, yoga sessions or psilocybin training sessions, or any number of things that could be happening at the premises. And that is very interesting. The rule that Kaci touched on about the ability, and this is an amazing rule, I think, the ability of a service center to essentially allow non-psilocybin activity on the entire premises or a portion of the premises while no psilocybin sessions are happening. And the fact you have separate client administration areas. I mean, I have one client who has 10 different client administration areas. So they have different rooms, just a whole bunch of different rooms, just like you would walk into a therapist's office or something. And they may contemplate having sessions going on here, but then they'll also have non-psilocybin normal therapy sessions going on here, and they can mix it up, and you can flick a switch and say, hey, here's a client administration session happening in this area, while at the same time something else is happening in another client administration area that's nothing to do with psilocybin. So it's really, I think, interesting. And Kaci mentioned those subleases. So what we've been doing, and this is, I guess, the third bullet point, or the second and third bullet point, but if you can, I think if you can do more than just psilocybin administration sessions, that's where you have your flexibility. And one second line of business, which would be, and again, a second line of business is sort of, this is trafficking. This first line of business is trafficking, and I'm subject to 288. This second line of business is not trafficking, and I'm not subject to 288. And you can think about the allocations that might take place between rental payments and whatever. But I think if a service center could, and I think this is, frankly, from what I'm hearing, this might end up being the prevailing business model, where a service center essentially rents out space. I mean, a service center could say, hey, I'm not providing service at all. I'm not providing the services. I just have the facility, the service center facility. I have to sell the client the product. So I'm a retailer in that respect. But as far as the sessions go, I am renting out my space to independent contractor facilitators who are bringing their clients onto my space and renting out my space. Now, that could be a second line of business of essentially rental income, which is not trafficking. But you could take the position that's not trafficking. And especially, and even that's divided between renting it out to facilitators for psilocybin sessions, or renting it out to anybody else out there in the world who's not even related to psilocybin. We have clients who are going to just rent out some space to just therapists from time to time, or for training, for training purposes or whatever. So you could just use your space as almost this area where at any given moment in time, any number of things are happening. Now you can't sublease, but we're not talking about subleasing. We're talking about temporary usage. So from a real estate perspective, we've just taken to calling these agreements temporary space use agreements. You're coming on my premises for the day with your client to use this area, and here's our deal. And we have a temporary space use agreement. And that's where I said rental income is second trader business. Now, I asked, I don't know how many folks have actually applied to the OHA for a service center. I've seen the application. I asked the OHA, I asked them this way back, if they would clarify that an applicant on a license could be two co-licensees. If you could have two separate entities be co-licensees on a license. This is permitted in cannabis. But the OHA was kind of slow to come around, and they didn't say that in the rules. And I called up Angela Albee and asked her this question. She brought in, of course, the DOJ attorneys, and they pondered it for a week or so and got back and said, yeah, okay, fine. So we can have two co-licensees be the license holders of record, right? Now, why would we want to do that? Well, the idea is, I think, that if you have a second line of business, if you're entity X and you have two lines of businesses, one that's trafficking, one that's not trafficking, you're probably going to get noticed by the IRS. Like that could be a flag that gets, oh wow, it's back to this Champs case, and it kind of raises a flag. If you have two separate entities and you say one's trafficking and I'm going to file a C Corp tax return and I'm totally trafficking, and another entity that's totally not trafficking, and there's separate returns with separate companies, the thought might be that you might not get flagged because you're not trafficking and not trafficking within the same entity. It could be considered a little playing games and fancy. And I know there's this has happened in the cannabis industry too, where we would set up these organizations for folks, and at some point, the more entities you have, the more complicated it is, the more bookkeeping and records it is. And there's obviously a desire for simplicity. Simplicity is great. And so that's another thing that should be considered on the front end. If you want to have multiple entities for certain reasons, you might have to ask yourself, is this, am I getting the bang for my buck, or should I just be simple? So, but the point of this is that the flexibility here, and I'm viewing all these rules and all these possible business models as kind of tools in a toolbox for the CPAs to figure out, let's, under the circumstances, based on your business model, let's do this. This might be the best thing we could do. And then you stick with the plan, and then you go about your business, like Dean says. You make a decision, you go about your business. Maybe a year or two or three from now, it gets revisited. And that happened in cannabis too. I mean, we had clients who said, who went the simple route and said, we need to sort of, split this off. And then we had clients who went the complicated route with multiple entities and said, we need to simplify. So down the road, things may change. But from the outset, I think it's important to kind of, understand what's going on, figure out what you want to do, make decisions, and then just go with it. I don't want to get too bogged down in this one, but Kaci, could you? Oh no, okay. This is the slide we're talking about. So I had some other clients who, a lot of facilitators here, I think, have other professional practices. They're psychologists, or they're therapists, or they're physicians, or they're whatever. Now, the OHA has made it very clear, and I think this is great, that that the facilitator, while they're involved in a Measure 109, any Measure 109 session, that they cannot be practicing some other profession. You can't practice psychology and be a facilitator at the same time. You got to put one hat on or the other hat. And if you're acting as a facilitator, you're not doing anything else. So everyone's staying in their lane. Now, I've had folks say, well, but that's the point. I'm a psychologist, and I talk to my clients about psychedelics, and I can't draw that line, and I have to do one, or you're basically putting a muzzle on me that I can't talk about all the stuff that I want to talk about. So very interesting issue for some people. Now, a Measure 109 preparation session is, as anyone who's followed the rules, it is a bunch of paperwork. It's a bunch of legal paperwork. It's an intake thing. I think I've heard folks in the rules advisory committees and the subcommittees complain that, like, this is not what a preparation session is in the underground. This is not what a preparation is supposed to be. We're supposed to sort of be preparing the client for the journey, and you're polluting it with a bunch of legal paperwork that is kind of a different mindset. And so so I've heard folks say, well, we're going to have two preparation sessions, one just to do the dang paperwork, and then one is like a real traditional legacy preparation session. Now, I have had folks, maybe let's say a psychologist who says, well, listen, can I just do my traditional preparation session as a psychologist, not as a facilitator? Just, I already have a business. I already have insurance. I don't want to be limited to what I want to talk about. I want to do this. Can I have a real preparation session outside of Measure 109 altogether? And you can think about how that would be in another entity with your traditional psychology business that isn't trafficking at all. So that's kind of just an interesting another toolbox. I mean, if you're a facilitator and you just take the position you're not trafficking, you don't need to think about this. But this could be another thing that somebody could do. Now, the integration session on the back end is also very interesting to me. If you look at what the requirements are and the rules for what a preparation session is, it'll tell you, here's everything that's happened in a preparation session. The admin session is obviously the admin session. But the integration session, which has to be offered to clients, but is not a requirement, what is an integration session? The rules don't say. I find that very kind of funny a little bit, but like, you know, do you want to have an integration session? Well, I don't know. What's an integration session? The rules don't say what it is. You can talk about anything. So I've also had the same psychologist who said, well, can I do my real prep session with my psychology hat on outside of 109? And can I do my integration session outside of 109? And just bifurcate these sessions between one thing that I have insurance for and one thing that I don't have insurance for and all that. So that's very interesting. You got to be careful on that. But I think it's a possible thing to do. We talked about temporary space use agreements and 2 co-licenses. Okay, Kaci, why don't you go forward if you can? All right, facilitators. This is the conversation that we all just had. But and this is an independent contractor facilitator. I've had a client say, well, you know what? I don't know. I'm really conservative and I don't want to, you know, I don't want to stick my neck out and I don't want to get audited, but so why don't I just admit I'm trafficking, you know, whatever, because, and I have 0 COGS, 0 deductions, but I don't really have any expenses. Like, what are my expenses? Not a lot. You know, my expenses might be my, you know, marketing, my, you know, my fee to the Oregon Health Authority, my annual fee, and a fair number of other things. But maybe I have some other business where I can kind of, you know, my psychologist business where I do all that stuff anyway, and I can mix it all up. And so I think that, you know, somebody could say, well, I'm just going to, Dean, I appreciate that, you know, you're saying I have an argument that I'm not trafficking, but I'm a conservative person and I'm just going to say I'm trafficking and I don't have many expenses. And so it's not going to hit me that much. Whereas many other folks might say, well, yeah, sure. You know, I don't want to deal with this stuff. So, and I like taking all my deductions. So I'm going to not say I'm not trafficking, and I'm just going to treat my business like any other business. And maybe I'll form a C Corp to protect myself. So I think facilitators, while 3 different CPAs might have 5 different answers, like a facilitator is going to have to take a position, or at least, you know, think about taking a position after weighing everything and say, hey, I'm going to do this, I'm going to take this position, or I'm going to take this position. So, and that's probably worth thinking about before you form your entity, or before you actually begin conducting business, at least, as opposed to like a year from now. You know, geez, it's time to file my 2023 tax return. We're in the middle of 2024. Have I been trafficking all this time or not? You know, it's probably better to think about that on the front end. This is one thing I've talked to both facilitators about and service centers. And to me, this is a little interesting. And I don't want to get too bogged down in this either. But if you have you know, what I'm thinking seems to be a common, if not the prevailing business model, where a service center rents out space to independent contractor facilitators. Okay. Now, who is paying who? What are the flow of funds? The client is going to pay the service center for the product. That has to happen because there's a sales tax, and so that has to happen. But for everything else, if you have a situation where a service center is renting out space for the day to an independent contractor independent contractor facilitator. Who is the client paying? Who's paying who? So Kaci, can you jump to the next slide? Okay, now keep in mind that if you're trafficking, you want to reduce your expenses that are not comics. So I've come up with the only 3 things I could come up with, I think. Alternative 1, the client pays the facilitator for all services, including the use of the space. The client is paying the facilitator X dollars for everything. And the facilitator then turns around and pays the space use fee to the service center. And the facilitator keeps whatever their fee is for their own services. So I think this is good for the service center because the service center isn't paying an expense back to the facilitator. Really, the service center is just getting rent. And so it's sort of like less money is flowing through the service centers. It's not like they're getting money and kicking money back to the facilitator. Oh, sorry, Kaci, there you go. On the other hand, what's good for one may not be good for the other, or what's best for one may not be best for the other. If the facilitator is collecting all the money from the client and turning around and paying a use fee to the service center, now the facilitator has an expense, right? You've increased your revenues because the client's paying you everything, and now you have an expense, whereas the service center only has the income and no expense. So that's kind of interesting. Now, alternative number 2, I might say this is better for the facilitator. The client pays the service center for everything, and the service center then comes back and pays the facilitator as an independent contractor. The reverse is happening there, right? Like all the money from the client is flowing through the service center, and the expense of the service center is not being paid by the facilitator. The facilitator is getting their income for doing their services. I have spoken with service centers who really like alternative number 1. And I've spoken with service centers who say, yeah, I see what you're saying about alternative. I'm sorry, I've had service centers who say, I want to do alternative 1. That's what's best for me. That's what I want to do. I've had service centers say, well, I see what you're saying, but that's not the way we're going to run business. That's, we'll do alternative 2. So this all depends on how you want to structure things, how you want to conduct your business. Now, alternative 3, I don't know. This is, if you want to say the best of both worlds, I don't know if this is too weird or unconventional or awkward for the client. I mean, you gotta do business with the client. Could the client pay the service center for the product and the use of the space? That's a strange concept. The client is paying the service center to use the space, and then the client pays the facilitator for the services, right? So this way, the service center is not paying an expense to the facilitator, and the facilitator is not paying an expense to the service center, and everybody's just getting income and nobody has expenses. I don't know. I don't know how this will work out, but this is up to the parties to decide what they want to do. And I think the way things are going, at least in year 1 here, Sam and Heidi, you can let us know, and anybody can let us know. It seems like we're going to have, a decent amount of facilitators who graduated their classes, and probably not an overabundance of service centers. So depending on who's got leverage, I might say, if I'm a service center and I've got a whole bunch of facilitators who might be wanting to use my spot, I might say, hey, I like alternative 1. That's the way it's going to be. But this is for the parties to work out and for the industry to work out. But it's kind of a flow of funds issue, which might be kind of interesting if this business model ends up being common. Okay, Kaci. So that's it. This is that was all just a summary of different business models, but it's meant to illustrate the flexibility of what's going on. I think that my rule of thumb is I would never tell a client or never speak at a webinar like this and say, facilitators should always do this, and service centers should always do this. It always depends on, there's no silver bullet answer for anybody. It always depends on what you're doing. What are the possibilities of what you're doing? And how are you going to run your businesses and offer your services? So, but in the cannabis industry, C Corps were, popular for retailers, because as Dean said, everybody recognized that 280E was going to hit retailers harder than manufacturers and like basically growers. For growers, which would be the analogy here is psilocybin manufacturers. For cannabis productions, I don't know. We sort of saw it like 50-50. Half of them were C Corps and half of them were pass-through entities, and they could probably survive either way. But I think the bulk of almost all of our cannabis retail clients were C Corps. But maybe Dean or Matt or Scott, you could weigh in on just kind of choice of entity for a second and the benefits of a C Corp generally.
Yeah, I'll jump in. I would say there's a lot of unknown. I think what we've been talking about today is there's a lot of unknowns in this pretty new industry. And I would be recommending C Corporation for just possibly all aspects of this business to begin with. That would be my default, but as I talk to clients and I get a little better understanding of their business and kind of what their intentions are, we may want to think about something else. Possibly, maybe for facilitators, a pass-through entity would be fine, but there's also some gray area in that. Scott and I had a discussion about, is a facilitator of trafficking, and how is the IRS going to take a look at this? So my default would be C Corporation. The benefit of that, sure, people say that there's a double tax and everything like that. Well, that's fine. There's a double tax when you pay a dividend, potentially, right? But a C Corporation's tax rate is only 21% versus 37% max rate for an individual. And if you're going to be, say, reinvesting in your business over a period of years, I'd rather be doing that at a 21% rate versus potentially up to a 37% rate, right? And, depending on what your other sources of income are as an individual, even if you paid a dividend out, you may not pay any tax on it. There's a 0% rate, a 15% rate, and a 20% rate, and it's all kind of income based. But definitely C Corp would be my first choice. Scott, you want to weigh in on that? Be fine.
Yeah, you made some fantastic points there, Dean, and I would lean the same direction. There's a lot of unknowns, just like when the cannabis went legal, 10 years ago. We were all in that same wild, wild west environment. We're there again with psilocybin. And the C Corporation, while there is potential for double taxation, you made a great point. There's lots of benefit on the tax side, depending on how you operate it. But I would lean towards C Corporation primarily because of those last two bullets there. One of the things we go over with all of our clients that are subject to 280E is the conversation of not if you get audited, it's when you get audited. The IRS has been, it's basically open season for them on cannabis activity. It's very easy for them to find who's trafficking in cannabis, and then they love to go audit. So we like to gear our clients up toward that mentality of not if, but when you get audited. You want to have all your ducks in a row, and you don't want to be personally on the table for the audit. You want the business to be under audit, but not you. And so not having a pass-through entity like an S Corp or a partnership or an LLC takes you personally largely out of the picture. Not entirely, and I'll let the attorneys speak to that, but the C Corp provides a lot of shielding personally. The IRS can look at the business, look into the business finances, but they're not looking through your personal tax return and looking at other things and trying to, turn over other rocks that you don't want them looking under.
Scott, or anyone else, really quickly, could you describe what a pass-through entity is?
Absolutely. So a pass-through entity is primarily a partnership or an S corp. There's a bunch of sub entities under that, but those are the main two. What a pass-through entity means is that the S corp or the partnership files its own tax return, but it doesn't really pay tax. It's an informational return, and then that tax return uses a form called a K-1. It's kind of like you get a W-2 when you're an employee. When you're a business owner, you get a K-1 from your business. So your service center will file a tax return, and it's going to say, here's all the information. Bottom line is there's 100 grand of taxable income. That 100 grand then it passes through onto your personal tax return. So when you have a pass-through entity on your personal tax return, business income shows up. Where in contrast with a C corporation, the C corporation itself pays taxes. So everything stays over here in the C corp. Nothing passes through to you as far as the bottom line business net income. So there's a very clear delineation between your personal activity and the C corp activity when you're a C corporation. That was a great question, Sam.
Yeah,
Was not mine, just for clarity, but wanted to do that. And then Dave, I do want to just acknowledge time here and start to wrap up where we can. We've got a handful of great questions that folks have sent in and want to make sure we have time for that too.
Go with the question, Sam.
With that, well, why don't you go ahead and cover the takeaways here?
Oh, yeah, this is the takeaway. It's a very, you know, on the one hand, maybe complicated and daunting. On the other hand, as we've said, it's something that shouldn't be dwelt upon. So I just think that it's a front end thing to think about with the right folks in your corner, and you make certain decisions and make certain plans and you follow through with them. So we had a couple of nightmare events in the cannabis industry where people just did stuff on their own and ended up getting burned. So I think hiring the right professionals, it's not rocket science, but it's something where I like to sleep at night. And so it's a way to sort of have some comfort that you've got folks who know what they're doing in your corner, nodding their head in approval that this is a reasonable course of action.
Yeah, I would add to that, Dave, that I'm sure Dean's been in the same boat, but when you have the professionals lined up, when you get attorneys set it up correctly on the front end, and then the CPAs are making sure the bookkeeping and everything is done with whatever position you've decided to take, when the IRS comes knocking and you go through an audit, it's a much different experience when you have professionals in your corner. We recently had our first no change cannabis audit where the IRS came in, picked through the whole business and said, you've taken a position and everything is defensible. And it wasn't a very conservative approach. It was fairly aggressive, but we were able to back it all up. And we've been able to do that for a client, and it's absolutely worth the time and energy on the front end to do it right, to make sure that when the IRS comes to look at it, you've got your ducks in a row and you know what you're planning for. I think going back to Dean's point early on, you don't want to focus on the 280E, but you do need to plan for it. So you want to plan for it well and know that this is an element of your business. In order to be successful, you need to do this part correctly, and you need some professional help to do it because it's not something you can do on your own.
All right. Well, with that, I'd actually like to introduce someone who many of you probably already know. She is Heidi Pendergast, the Healing Advocacy Funds Program Director. I want to hand it over to her to help co-pilot here on the Q&A. She's been taking down a lot of your questions, many of which have been answered, but a handful of them have not been. So Heidi, if I can go ahead and hand it over to you, let's go ahead and dive into Q&A here.
Excellent. All right. I think this first one is for Dave and Kaci. If a facilitator group or group of facilitators were listed as co-licensees on the service center application, would the temporary use agreement still be required, or would they just be licensed to use the facility?
So if the facilitators also own the service center, you know, I'm an owner of a service center, but I'm also a facilitator. I'm going to facilitate at my own service center. Yeah, we have some of those. Again, you've got some flexibility. You can become an employee of your own company and take a salary as a facilitator. You can set up your own independent facilitator business, and then basically have at your service center could have a space use agreement with your facilitator company. So you could do either. It depends on, one entity, two entities. It's a conversation with the CPA and the attorney, but you have the flexibility to sort of structure it how you like. I think if that's the question.
Yes, that was the question. And the follow-up here, which I think kind of dovetails, is how shielded or not is your facilitation work in your own service center?
How shielded. So can you, what do you mean by that, Heidi? what do you think we mean by that?
I am
Whoever
not sure.
asked the
Sorry,
question can chime back in the chat with
Okay, yeah,
additional
yeah.
details, and let's just keep
Absolutely.
going.
All right, great. Sam, this one is for you. As a healthcare provider, am I able to practice medicine completely outside of facilitating, still at an unrelated business/clinic?
So the first thing I want to say is I'm not an attorney or a tax accountant, and this is not legal or tax advice at all. And primarily has nothing to do with 280E, which is why the question came to me. But let me tell you why the question came to me is for all of the healthcare providers that may be moving forward and being dual licensed and carrying a closet full of hats, as the analogy goes. The Healing Advocacy Fund has been directly in contact with almost every relevant healthcare licensing board in the state of Oregon. We recently gave a presentation to the Board of Naturopaths. I gave a presentation to the Board of Psychology last week, actually, which will have a lot more information on some very interesting developments on both of those fronts, and continue to engage with all of the other boards in terms of the Board of Nursing, the Medical Board, Social Work Board, et cetera. We are early on in the stages of those communications, and frankly, they are less communications and more about education. Despite being 3 years after the passage of Measure 109, education, guess what? Here we are, still relevant, frankly, more relevant now than it's ever been, given that we're about to have the first service centers open their doors, and this thing is actually going to get up and running. So stay tuned. We very well may hold this exact type of webinar for healthcare providers. If I had to guess, we will have somewhere between 5 to 10x the audience based on the conversations I've had with folks in those various fields. And I do think that, you know, something that Dave brought up really lifts up the importance of ensuring that we do have clarity for mental health care practitioners. And that is where there are creative opportunities for licensed healthcare practitioners to bill insurance on the preparation and integration side of things. As Dave said, those are creative opportunities. Those are things that are still moving forward. But I just had a conversation earlier today and found out that there is someone who is already doing that. And you know, those are things that we're very interested in. Everyone here is interested in that. You know, it's no secret that there are many financial barriers to entry here. And it's going to take all of us to produce solutions, not just to talk about the problems. That's easy. Coming up with solutions, working together, that's going to help ensure that we continue to pave the path to a affordable and equitable psilocybin program long-term. These things do not happen overnight. It takes a village. It always has. It always will. That's my answer to that for that question now. Stay tuned for more. Back to you, Heidi.
Excellent. Thanks for that, Sam. Next question we have is, I'm very curious how IRS Code 280E may pertain to organizations that may be set up as nonprofit religious organizations who may wish to eventually offer psilocybin services and facilitation as a recognized sacrament used within a spiritual religious context.
The religious context has gotten a lot of, there's been a lot of talk about that over the last year or two or more. Well, first off, a nonprofit corporation can be a licensee under the statute. Nonprofit corporations are taxed as C corporations, right, guys? I mean, if you're a nonprofit, you're essentially a C corporation, right. And you don't get out of 280E by being a nonprofit. And I think getting a religious exemption, a tax exempt entity here is impossible, right? So it seems to me that you can go ahead and be a nonprofit, but it's from a tax perspective, it's no different than being a C Corp. As far as your religious practices or the type of service center you want to have or the type of facilitation services you want to provide. I don't know. I always thought that this is maybe not my area of expertise, but Measure 109 is broad enough that you can provide any type of, facilitation services that you want. You could have any angle that you want from how you go about doing this, a philosophy. But I don't really. I always struggle with how is this legally different, and I never came up with an answer. It's like, if you want to practice, if you want to be a facilitator and focus on indigenous practices, great. If you want to focus on what you consider spiritual or religious things, great. If you want to do something brand new that has nothing to do with indigenous practices or nothing to do with spirituality or whatever, great. Like the OHA, I don't think gets too up in your business about that, and I don't see what it has to do with 280 and tax laws. But any of the CPAs can weigh in there if you want to.
I'll jump in there. Let me start out by just saying not-for-profit is not my specialty, but you're absolutely correct that 280E would apply as if they were a C corporation. The operative piece there, I believe, is just because you are registered as a not-for-profit does not necessarily mean you cannot engage in for-profit activities. Those are unrelated activities, and then they are taxed as if you're a for-profit corporation. So you can have a religious entity that has its normal activity, not for profit, but then has a separate activity, speaking of two lines of business, essentially a separate line of business that is engaged in for profit. So if you're selling and administering and facilitating psilocybin for profit, that doesn't matter that you're a not-for-profit up front. You have a line of business that's not for profit, and 280E is going to impact it.
Yeah,
Thanks for that.
I would add to this. If you're thinking about this as a tax strategy, I'm going to go back to our early comments. Don't think about 280E. It's taken it too far. So
Back to you, Heidi.
Thanks, Sam. All right, and we have I've opened up the chat so people can actually put their questions directly to the group in there. We had a few more that were private messaged just to the host, so I'm going to run through those, but people can start to put their questions into the chat as well. So there's been a big question about what if facilitators establish a facilitator company and the service center is relegated to simply be a provider of the facility and psilocybin. Can 471C mitigate the expenses for the facilitator group? This way, the service center can pay for its own costs and charge enough to make a profit, but be subject to a relatively low 280E impact.
And I would ask that whoever takes this, please explain what the hell 471C is.
I'll let the CPAs explain 471 in more detail. But I think this is the business model that I had mentioned, I think is becoming a common business model. And we talked about the flow of funds. So
common business model in cannabis, right? Or you mean in psilocybin as well?
In psilocybin, I guess I mean that like I was always wondering whether a service center would have its own workforce of facilitators. I'm a service center. I'm employing a half a dozen facilitators who are my full-time facilitators. And we're just a team, right? We're one team and we're doing all this stuff. And I don't know if I'm seeing that too much. I think maybe in a super microdose model where facilitators are not overly important, and you have one facilitator for group sessions and you're churning out microdose clients. I could see having, clients aren't going to have their own special microdose facilitator, right? I mean, that's not what you're doing. So I think that's, those folks will have employees. I think if you're some big destination resort, you're going to have employees. But I think the bulk of folks in the middle, from what I'm hearing and what I'm seeing, is that a lot of service center folks are saying, geez, I think it might make more sense for me. I've got a great piece of property. I've got this, and but I don't, I don't necessarily want to take on hiring a whole bunch of people. I know there's going to be a lot of facilitators out there. Like, it might be a better business model to open my place up to other facilitators. So I think that's what we're talking about. Now, how 471C plays into that, I'll let the CPAs figure that one out. But I think from a facilitator standpoint, we go back to what we said, like, are you trafficking in the first place? Maybe not, yes or no. And who's the flow of funds going, and who's paying whose expenses? And so, Dean or Scott, do you guys have any 471 comments, or is that worth getting into the details? Or 471's not some big panacea that's going to change 280E?
I see the question on here. One of them was saying that, some cannabis attorneys and accountants are, have been using 471C as a way to take non-deductible expenses. Well, first of all, that's wrong. And the regs that came out, I don't know, Scott, 6-8 months ago or something like that, finally addressed that. There'd been a lot of discussion in the CPA world about what 471C meant. If you're a business person and you're citing subsections of the Internal Revenue Code, that's pretty technical. Outside of, I've been practicing for almost 40 years, and I've never had another client talk to me about a specific code sections in the Internal Revenue Code, right? So 471C, well, section 471 is just, there's two sections in the code. One is 471 and the other one is code section 263 capital A, which talks about inventory accounting methods. Okay, those are the two big sections of the code. 471C came into being in 2018, and for most clients, and that means for most taxpayers, if you have less than $26 million in annual trailing 3-year sales, or you don't have basically an audited financial statement, you can use what's called we kind of term it the QuickBooks method for your inventory accounting. Okay. So if you don't really keep inventories, or you put X, Y, and Z in your, inventories and cost of goods sold, that's fine. It's a simplification provision. Some people took that to mean, oh, if I deduct everything in my QuickBooks file, even though it would otherwise be non-deductible, magically now it can be deducted. Well, that's just not the case. So it's just not.
Yeah, and now I see Jesse's comment in the chat room. And I think when Jesse said 471C loophole, I have heard that word a lot. And I think the perception was like, oh, this is some great new thing. We can avoid 280E. And we had our share of cannabis clients do that on their own and run with that. And they either got burned or they're probably going to get burned. There's no loophole. There's no loophole. There's strategies, and you can pick around the edges, and you can take positions on whether you're trafficking or not, but that's not a loophole. These are legal positions. And if you have attorneys and CPAs who are going to say, like, get on board with these positions, I think you've got some real good protection. But there's no loophole.
No.
Yeah, I think
I don't want to fixate on that word, but I'm just saying, like, that was the thought process. And I had to, like, battle clients. I'm like, talk to my tax colleague, like, you're doing this wrong. And they're like, whatever, half of them ran with it.
Yeah, I think directly to the point of the question there was, can 471C apply to facilitators? And if you look at the actual verbiage of section 471C, there's two relevant sections of 471. There's B and C. B applies to merchandise purchase. That's essentially the retail side. And then C applies to merchandise produced. Well, a facilitator is not producing any product. So that section of the code is not going to be relevant to them, no matter how they spin that. That's going to be a slam dunk case for the IRS.
So I had a little bit of a follow-up question, just regards to, it seems like right now, and this is coming from Todd Foster with Oath Insurance, who I think is bringing this up. Todd, I'd have you come up, but then we'd have to let everyone come up. So I'm just going to ask the question here, and you can feel free to chat me if I butcher it. But we can get coverage for service centers, but professional liability for individual facilitators is few and far between, is what I'll say. I'm not going to make any absolute statements at the moment, but what impacts does that have in terms of folks' business structures or considerations as it relates to 280E, if at all?
And this is Pine's question, Sam. I'm seeing in the chat room, or no?
No, this is a direct question that came to me.
Okay. So insurance. Okay. If you're talking about, I think we're talking about professional liability insurance. I'm a lawyer. I have malpractice insurance. Dean and Scott, I assume you guys have professional liability insurance. Facilitators may not have such insurance from a professional liability. Well, all doctors have it, psychologists have it, every licensed professional have it. It may not be available here. It may be available and it may be affordable, or it may be available and it may be cost prohibitive. So that's a big old question for facilitators. Now, if you don't have insurance, you can either say, well, I don't want to, I'm not going to participate in this industry. You can go home. You can also just try to protect yourself from a business standpoint with as many liability waivers and releases as you could possibly imagine. I'm going to go skydiving and I'm going to sign this crazy release that says, no matter what happens to me, I'm assuming the risk of that. And so that's what I would do. That's what I would draft for a service center client who's providing services, or for a facilitator who's providing services. If the client is embarking on this experience, and it could be a great one, it could be a bad one, this could happen, that could happen, you're assuming everything. And by the way, all the facilitators know that what they're doing in a administration session is very non-directive. It's not my area, but you're not supposed to be practicing psychology, or you can't, but you're not supposed to be doing that much in an administration session. So I think the best you can do is protect yourself with liability waivers. And I think is that the question, Sam? I mean,
I might have butchered the question. I owe Todd.
I don't know if that's it. I mean, everybody's going to form an entity. Nobody's going to do this in their individual sole proprietor capacity, because you don't want to subject yourself to a personal lawsuit. But I think, you have entity protection. You have to be capitalized. There's this theory of piercing the corporate veil, or piercing the entity veil, where a plaintiff can get through the entity to you personally. And one of the ways they can do that is if you're not adequately capitalized on the front end, and insurance is a way to be adequately capitalized. But if there's no insurance available and you're out there doing services, that is an issue. So I think if you're an employee of a service center, you're kind of covered, because the service center is going to be liable. If you're on your own, it's a big issue.
Heidi, let's kick it back to you. I know we had a really good question about potential conflicts between different operators in this space. Go ahead, Heidi.
Yep, and just before we do that, we had a follow-up question on this topic. Even if a person signs a liability waiver, could a spouse or family member who didn't sign sue a facilitator?
Well, it's America, so I suppose anybody could sue anybody. I don't know. There's some kind of tort. I mean, if I cause someone's death or disability, there is a family member, spouse could have a wrongful death action against me, or some sort of tort. So it's possible. I think that the facilitator providing services to the client, but actually under Oregon law, you can protect yourself with waivers. I mean, the problem, you would, unless you did something that was outside the rules, or you were grossly negligent, you're going to probably win the case. But the problem is getting sued in the first place. I mean, one of the best things about insurance, professional insurance, is if you get sued, you just tender the case to your insurance company and they fight the case. I mean, they hire the attorneys to either settle the case or to resolve the case. But if you're on your own without any insurance paying your legal defense costs, like that's the problem. And to say to yourself, well, you know, for me to say, well, you're probably going to ultimately prevail. You're like, well, geez, thanks a lot. Great, I won, but you know, how much did it cost me to win here? And what did I win? I didn't win any money. I just, you know, made the plaintiff go away. But liability insurance is a big risk. I mean, Sam, you know, just for the well-being of the industry, I think that is the, I might say even just as much as 280E or anything else, like affordable professional liability insurance is kind of a big one.
Yeah, we know there's people that are working on it, but stay tuned, you know.
Yeah.
Back to you, Heidi.
All right, next up here we have, with the potential clash of business models, if a facilitator takes all the money for the admin session and then has to pay the service center, are they not getting penalized with 280E and will have to pay taxes on all the money they accepted, as the expense they paid isn't deductible? And then vice versa, when the service center takes all the money, and are these phantom profits?
Yeah, I'll take that one. That's exactly the scenario that was run through in those three hypotheticals. So that question indicates that the person understands how 280 operates. So that's exactly right. That's why that third option that Dave mentioned, where potentially you could have the client having two payees. So the client is paying the service center for the use of the space and separately paying the facilitator, who's an independent contractor, for the services. Perhaps that's the best of both worlds.
Now, if a facilitator is going to take the position they're not trafficking at all, then, you know, whatever. I mean, I think you are going to have, if you're doing the model that's more favorable to the service center, the service center, the facilitator is going to have more revenues and they're going to have more expenses. But if you take the position you're not trafficking, you're just like any other business and you're just going to pay tax on your profits. Now, the potential problem would be, if you're wrong, if one day a court says, you know what, all you facilitators have always been trafficking, you know, now your tax liability is more than it would be now. But you have a C Corp, and your C Corp is your next backstop. Your first backstop, your first argument is, I'm not trafficking. The IRS knocks on your door one day and says, I'm not trafficking. That's your first line of defense. Your second line of defense is, well, okay, you determined that I owe you a zillion dollars, so I've been trafficking all this time. Well, I've had a C Corp. I'm not personally liable. My C Corp is bankrupt. Nice not doing business with you. And you go home. We had cannabis retailers who shut the doors because they realized they had too much tax liability. They were never going to make it. And I had one client who owes the IRS $500,000, not personally, but the C Corp does. And they just let their license go. You know, goodbye, I'm going home. Not personally liable. Didn't work out. So, you know, that's the risk for the facilitators, is that, you know, you got a couple lines of defenses, but you have to figure out what you're going to do going in. Service center, yeah, but that's the issue. As Matt said, whoever asked that question gets it. Like you get it. And depending on what you are, you may want to say, I want to do business this way or this way. And maybe if the industry adopts this sort of best of both worlds standpoint, no matter how awkward it might be, if all clients say, okay, I'm paying two people. I'm paying the service center for the product and the space, and I'm paying the facilitator for their personal services, not for the space, just for their services. Then nobody's paying anybody except the service center is not paying the facilitator, and the facilitator is not paying the service center. Whether that is adopted as a business model, I don't know.
That might end up being less awkward than it initially sounds. If we run into the same banking and point of sale processing issues that cannabis has, where for the front end years here, we might have cash basis businesses. Very easy to split that cash up front. The client gets an invoice from both activities and pays one lump sum, and then the cash divvies out into the two activities from there. So from the client's perspective, it can look like they're paying one entity, but it's actually being split two ways.
And think about a service center who is renting out their space to independent contractor facilitators. If their second line of business is renting space, and they're only getting rent from the facilitator, like they don't even really have many expenses related to that line of business. Like they're just getting the rent. And yes, you know, they're paying ultimate rent to the landlord, the service center is, but it's not like there's any labor expenses or any other expenses. They're just getting passive rental income. So it's kind of a potentially sweet deal for the service centers who, you know, might be in the driver's seat here in the beginning.
Thanks for that. And then I know we're coming to the end here. How much of the structuring advice is unique to Oregon, or does it work just as well in Colorado?
You know, Colorado has a very similar model. So at least one part of Colorado, the measure has a very similar model. So I think this would translate to Colorado. I mean, there might be tweaks to it, but by and large, it would translate. Colorado also has this sharing model, which is really interesting, and I think the legislature is stepping in to change that right now, which is almost, you know, it looks awfully like the underground model, and I don't want to opine on that right now, but that's a potentially other ballgame. But I think sort of the regulatory license model, it would be quite similar to this.
Yeah, and stay tuned for our friends in Colorado. We've got a team on the ground in Colorado, many of which are here on this call as well. Maybe the question came from one of them. So I think we'll definitely be hosting more of these. And I do think it's a really good question to dig into for all the folks in Colorado who are about to be in the same place that all of our friends here in Oregon are as well. So it's a great question.
All right, we have one more of the direct questions as well too. So, and Sam, I think this one's for you. Who regulates the costs in all of these various scenarios? Anyone outside the business entity? Is there a set price fee that facilitators or service centers can charge? And it goes on to talk about how this kind of intersects with equity.
Yeah, absolutely. So cost is probably the biggest thing in the media right now, right? You know, and it's prohibitive for a lot of people, straight up. Like, let's not beat around the bush. Several $1,000s is going to be prohibitive for a lot of folks who stand to benefit from having access. With that said, these things are not going to be affordable overnight. This is still a federally illegal substance. If you've learned anything from your webinar today, it should be that there are additional things above and beyond the cost of licenses, which are also prohibitive for a lot of folks. I think over time, those stand to come down. But at the end of the day, federal illegality is one of the biggest financial barriers. There are many others, but it's not small, and it needs to be considered. With that said, you know, there are going to be many short-term options that folks are going to be utilizing. Some of them are mentioned here. Some of the first service centers that we know that are going to be opening their doors over the next couple of months here are incorporating nonprofit models on the front and the back end. That can cover the costs of some, maybe not all, but some of the costs of services. In addition to that, one of the things that I'm very keenly interested in is figuring out the pathway to overall insurance 3 to 5 years from now. There are many steps between now and insurance coverage, and changing federal laws is just one of them. There are more immediate steps that I believe that we can start thinking about and talking about now to incentivize the state to invest Medicaid dollars into this program. That's not going to happen overnight either. It's going to take Medicaid pilots. It's going to take continued philanthropic donations, and it's going to take a lot of hard work that involves not only the community, but decision makers and lawmakers as well. With that said, I am confident that if we are able to come together and continue to focus on solutions, not just the problems. I do believe that we have a real opportunity to not only show the state of Oregon, as I believe we're set up to start doing over the next couple of years, that psilocybin and this program can really help people who are otherwise not being served and met their needs met, but that there's cost savings for specific populations within the Medicaid program here in Oregon. I think long-term, that is one of several different options that we're going to be pursuing. We're not going anywhere. I don't think any of the attorneys and accountants aren't going anywhere. I'm sure many of you here that want to be involved in this program aren't going anywhere either. And I invite you to participate in those solutions. Again, some are short-term, some are long-term. But if I had $1 for every time that someone talked about costs without talking about solutions, I bet we'd have enough money to start providing more access to services. And I really think that it's time that we start coming together and create more spaces. That includes us, to start really talking about those solutions, because that clock doesn't start until we start working on it. If we don't start talking about how to incentivize the state to invest in this program today, it's going to be that much longer until we're able to get to them. And I do think that there's an important timeline scenario and where we really need to put our money, our time, and our resources where our mouth is. And so with that, I want to step back and thank all of our incredible panelists today. This was one of the most coherent conversations I have personally heard on 280E and psilocybin, if not cannabis as well, frankly. I really think that's a credit to how many seasoned experts we have here. Really just want to thank everyone again. This was recorded. We will post this on our website at the Healing Advocacy Fund, and I'm sure we'll also send it out via email. Stay tuned for additional webinars just like this one. We've got so many topics to cover. There's so much going on. We're doing our best to try and keep everyone informed, and we want you to help inform us as well. We really invite feedback on other questions that maybe weren't asked or that weren't answered, so we can continue to have this conversation and really build a path forward to where everyone that stands to benefit has access over the long term. So with that, thanks again. Really appreciate everyone. Have a good Tuesday. Bye now.